You're listening to What's Up Digital Lending, the podcast that explores the exciting world of digital lending. We make a deep dive into the most important issues and talk to the leading minds of the ecosystem.
Welcome everyone. My guest today in this episode number 3 of What's Up Digital Lending is Christopher Grätz. He is the COO of INVESDOR from Berlin. My name is Constantin Fabricius and I am the host of this podcast. INVESDOR Group is a digital lending and investment platform active in Finland, Germany and Austria, which grew up out of mergers. Now it wants to join forces with One Planet Crowd from the Netherlands, and the goal is clear. INVESDOR wants to become the first pan-European platform. It's a pleasure to have you here, Christopher. Welcome.
Thank you so much for having me. It's a pleasure to be here as well.
Now pay attention, please. The content of this podcast is expressly not to be considered investment advice, but is intended solely for your information. We do not assume any liability and will not share any profits. Christopher, may I ask you to introduce yourself, since we have already heard a little bit about your company. Who are you? And please tell us a bit about your professional career.
Perfect. Thank you so much. Yeah, my name is Christopher Grätz. I'm born and raised in Berlin. I've worked for various banks before, did an apprenticeship in the bank here in Berlin, worked for KPMG consultancy in the financial services field, management services. So we consulted banks all over Europe on various projects, digitalization, how to get closer to the customer again, process optimization. Those were my topics that I worked on until 2014, end of 2014, where I felt like my view on the banks was that obviously it's a huge industry, it's a necessary industry, but a lot of those questions of how do I digitalize, if you make a concept about this, it often ends up not being implemented. And how do I get closer to my clients? Often the question was not general to say like, I want to have engagement and contact to the clients, but it was often a question of how do I get them into my branches? Because I have these branches already. And I felt this is not the trend to go forward. I also worked on SME credits on the other side, where you could see the processes, the time it takes, the effort it takes for the company. And you could also see that it's not very valued. So our idea was in 2015 to found a company called Capilendo. That's what I did back then. We were the market leader for crowdfunding or crowd lending purely in the German market, focusing on German SMEs on the one hand, and we only had senior loans on the other hand to as investment opportunities for the crowd, for retail investors and institutional investors, and developed from there through, as you mentioned, various mergers and ideas. And yeah, I can definitely dive more into this over the podcast.
Okay, thank you. Great. And just to mention, Capilendo is one of the fellow founders of our Trade Buddy back in 2019. So it is, something very special today for this reason. Let's take a deep dive into INVESDOR. What exactly is INVESDOR's business model?
We are a European platform for retail and institutional investors to invest in basically all types of companies at all stages of their life cycle. We focus on Central and Northern Europe. So we currently a platform that is offering investments into scale-up companies, early stage, from really pure equity. You can invest in shares, you can invest in other types of equity products in the early stage, over the lifetime of a company by having hybrid products like convertible bonds, for example, up to loans. Might they be subordinated with interest kickers if the company is more successful, to really, really stable loans for SMEs that are definitely at the final stage of their life cycle, highly established, purely fixed income investments. That's the focus we have on the business side. And we offer these for companies coming out of Finland, coming out of Germany, Austria, and we will add the Netherlands, because we highly believe that crowdfunding is something where you need to diversify. And you don't want to diversify over various platforms. You want to have one partner you work with that has established standards, that is highly professional. That's our belief, and that's why we offer this broad range to diversify between maybe a scale-up where I like the business model and I feel, okay, it's too early stage to only go for fixed interest because the upside is limited. So I want to have equity and I want to participate in the exit. up to companies where I feel like, hey, it's a company around the corner making a lot of money. Why not give my money straight to this company, knowing who's having my money instead of putting it on a bank account with lower interest? And what we highly believe in as well is that sustainability will become more and more important. Asset allocation also into renewable energy products will become more and more important. And that's why we decided to merge with One Planet Crowd, who's Europe's market leader in sustainability investments. It will bring the opportunity for us to also enter the Benelux region. As if we say Northern and Central Europe, we were still missing the Benelux definitely there, so we can enter this market for scale-ups, SMEs, and we will add the asset class of renewable energy projects.
And tokenization already plays any role?
Tokenization plays an important role for us because we also believe that crowdfunding needs to be a liquid product, especially if you're not only doing short-term loans, but if you have, let's say, a renewable energy product where you invest in a solar farm, you get 5-6% interest, very low risk, but it's a long-term time of maybe 10 years. Then you want to have the possibility at a certain point in time to maybe sell the product, right? And get back your money. So we want to move from, crowdfunding comes a bit out of the gray capital market, was not highly regulated. With the European license, now it is regulated. We have this license. And we want to move to securities in general, to digital securities. And to make a digital security, tokenization is one way to do it. So that's important to us to make the product in itself tradable and more liquid. However, we don't tokenize because we love the blockchain or something. It's the the value that comes out of it for the user, without it being an implication in the user flow or something. So if you invest in a tokenized or non-tokenized investment on our platform, doesn't make any big difference for you in the way how you invest. But obviously, moving to more tokenization and digital securities helps you to trade them in the long run.
Okay, interesting. Let's talk numbers. How many projects has INVESDOR Group financed to date? And could you please also tell us something about the total volume issued to date?
Yes, absolutely. I will include One Planet Crowd in this already because we're about to close the deal. It will happen in the first quarter this year. So we already work as one company, basically. And if I put this all together and include this in the INVESDOR Group, we have financed over 830 projects in the past and more than 460 million euros in volume to these companies and to these projects. The current crowd consists of 170,000 registered users that are on our platform, coming from Finland, Germany, Austria, the Netherlands, and further European countries. And the European license will allow us to grow this even more to be in the center point of a capital market. Okay,
interesting. We have spoken already about the different mergers, and what is now interesting to me is, are there any further mergers or acquisitions planned for the future? What can we expect from INVESDOR?
It's open. It's open for discussion. I cannot say yes, I cannot say no. There's no merger that we have sort of already agreed on. We are in close contacts with a lot of companies. We obviously look into the market. I mean, right now there are a lot of players out there. Europe, I think, has seen the potential of crowdfunding, and that's why within Europe there's the new so-called ECSP license, which is a European license that harmonizes the way you can treat investors. It's sort of in the forefront of building one capital market union, which we can already see in the US, we can already see in China, and which we're really lacking behind in Europe. So this license kicks in November this year latest. A few platforms already have it. A lot of platforms are trying to get it. This will definitely consolidate the market. So there will be a lot of national players that are not highly regulated today that might step out of the market. There will be some players like us getting the license and expanding, and there will be some in the middle that, want to join European groups. I think if we look in further mergers, again, Central and Northern Europe is what we're looking at because we feel companies are equal, investment processes are equal, and I think it's easier for an investor from Germany to invest in Scandinavia or to invest in the Benelux than it is maybe to invest in Eastern Europe or Southern Europe because culturally there is still a difference between these markets. So this is our focus point. Our general idea is that we want to be sort of the most European of all the local platforms, but the most local of all the European platforms. So that's why we don't believe in purely growing digitally. Like, who am I or who's my investment manager team if we would go to Sweden to know what a Swedish investor wants or how a Swedish SME works. Like, we don't believe in that. So one way would be opening offices and getting people in. But if you're new in the market, you might make mistakes, you still learn something. So we highly believe in a track record to pick the right companies, to pick the right platform. So yes, we are open to talks to see like how can we expand in the other markets, but we have enough to do also with the mergers that we just did to bring this all together and to execute it.
Okay. Yes, absolutely. I believe that. But let's drill a little bit deeper into your business model so that we all can better understand what's up on both sides of the marketplace. Let's start with the companies seeking for financing. What do they look like? Could you please tell us the details?
Yes, I was expecting a question like, what's the typical company? Because obviously we have a broad business model, right? So if we talk about the typical company, we need to divide into scale-ups and SMEs in general. And then we have project development for real estate, which for renewable energy projects, which I would take out of the consideration now. So looking into the typical companies, these are either really early stage startups, which always need to have a certain proof of concept. That proof of concept can come from already existing revenues. The proof of concept can come from the team and the experience of the team. Those are companies that we would only finance with equity products. We don't believe, and we see that in the German market, obviously, that there are platforms out there that use debt products to finance startups at early stage. That's too high risk. So the upside is limited, always limited, because you're not fully in an equity position. The downside is obviously young companies can fail, right? So these typical companies we finance with equity, again, early stage, but they most often, from our point of view, need to have a business model that we highly believe in. They're often VC-backed already. They're often in the field of sustainability. And currently, they're mainly coming out of either Finland or they're coming out of the Benelux markets, because having a real equity product in the German market is not as simple. So we're working on this. It will come throughout the year. But again, everything that we see currently in the German market does not fulfill the quality standards that we have. But those are early stage companies. Again, from sustainability, medtech, renewable energy, clean tech, all types to solve. We always look into which company is trying to solve the essential problems that Europe has, right? From climate change over energy transition that needs to happen, local productions, like the challenges we have felt, I think all of us have felt over the last 2 years. These companies trying to solve those challenges, these are the companies that we want to bring on the platform with a clear equity product. And then we have later stage companies that, from our point of view, are often out of the equity field. So whoever's founded the company doesn't want to dilute anymore, and he has all rights to not dilute anymore because the high risk phase is over. The company has reached a more stable stage, is profitable. We can finance and analyze based on a track record. So we can not only, with startups, you often look through the front window and see like, okay, what's the road ahead and do I believe in this? With SMEs, you more look into the back mirror and say like, how have they performed in the past? And that's the proof of concept. And that's what we analyze, look into the numbers. And these can be, family-owned businesses. They can be large companies. I think we had companies from 1 million in revenue up to companies 500 million in revenue, from, 10 people working for the company up to 3,500 working for the company. So it's a broad range, different regions, different branches, industries, asset classes. Again, to give the investor the possibility to really diversify and pick what they are interested in. We steer our portfolio based on, if we look into the debt side, based on really looking at all cases. So really always looking into what's the total volume, what's the total interest, the total default rate, etc., to always make sure that we have a positive net return above 4% at least on fixed interest. That's what we're looking at.
Okay. We will come back to this in a couple of minutes and elaborate a little bit more on this because that sounds very interesting. Let's look on the other side of your marketplace. What does the typical investor look like?
Another question about the typical investor. Being a European platform makes it harder for us. And I think you have to understand we are a merged company, right? We are a combination of 4 market leaders. It's Capilendo that was founded in Germany with senior loans. So the investor base that we brought into the merger was very debt-driven. We never offered any equity product. So everyone we grew in the investor base was looking for fixed interest products. Finest from Austria, same positioning. Investor from Finland, completely different positioning. A lot of business angel, a lot of people that want to invest into equity, early stage medtech companies, very, very equity driven, a bit less fixed interest focused because we never really offered fixed interest products. And now we're adding a Dutch crowd, which funnily enough combines a bit of all. Their sort of consistency is sustainability, but they have offered SMEs fixed interest products, but they also have offered equity, and with renewable energy, most likely the most, let's say, secure or stable fixed interest asset class. So the investors are really from 18 to 90 years old. On average, I think they're 42. On average, they're a bit more male than female. And 170,000 users on the platform, out of which around about 65,000 come from the DACH region and the rest from the Nordics and the Benelux region. What's important to us is that they have different appetites. They have different risk appetites. They have different return expectations and appetites. They're looking for someone to invest into national companies and I want to support, my region only. Something very European and say like, hey, sustainability is important to me, but it doesn't matter where the company is coming from. Yeah, and it's the main challenge we have is obviously building one marketplace that can serve them all by clearly defining, giving information about the companies, being as transparent as possible, and offering people the opportunity to build their own portfolio based on their own interest.
Okay. Can you perhaps say anything specific about the share of funding from private investors compared to institutional investors on your marketplace?
Yeah. The share of funding is around about 90% is private investors, around about 10% is institutional investors. We have co-placed with institutional investors in the past as well. So there are often funds involved. Could be on the renewable energy bit where the crowd goes in, but there's then always also, or often also, a energy transition fund, for example, coming in. It could be VCs coming in. That's not counted in our volume. They're not running then through our platforms. They're more partners on the site. On our platform, 90% retail, 10% institutional. And I think there was a point in the market where everyone started with retail, or a lot of platforms started with retail. And then a lot of platforms realized retail is a difficult business because you need to fulfill various expectations, which we felt that's the USP we have. And that's where we focused on those. While a lot of other platforms that might be still seeing as crowdfunding are actually funds in the background and handing out the money. It's a fully different approach. And I can also understand arguments from both sides. Again, I think it's easier to have one focused client. With the growth, obviously, we also talking to funds. They see the advantages with us, again, that we bring this broad diversity of asset classes and we have the knowledge to bring it all together. So we see how the development goes. I think the European license, again, will allow us to grow also on the retail side. We talk to a lot of funds at the moment. But yeah, that's the distribution we have right now.
I think that this asset class is really appealing, and it, from my personal point of view, it has all potential to grow in the future. And yes, we had that summit back in at the end of October in Cologne, our first investors summit. And what I can tell you is that there were almost 30 investors from Germany and abroad, and they were all very interested in this asset class. So I think the story will not end here.
100% with you. I mean, I clearly agree. If people think about crowdfunding, it's often either just put into the startup corner and say like, that's something, for early stage companies and not for the relevant capital markets. And institutional clients obviously also think like, it's still such an early asset class. But I think if you really look at it, the professionalization that has taken place over the last years, moving into real license, moving into securities, making them more tradable, track records that we have built, volumes that we are capable to finance. I fully agree. It's still at the beginning as an asset class. Maybe for some of us founders, obviously it feels more like a marathon than a sprint. We have expected this to go faster.
Yes,
but at least now, also the political will on the European area is there, understanding that this part of the capital market of, financing, I mean, our license allows us now to finance up to 5 million euros per year for a company. That's something that is underserved. Like if the only way you had is going to a bank or going to the private sector, but not to the markets. And we are this new capital market for that part of the industry.
By the way, congratulations. I saw this notice on LinkedIn today that you finally received your authorization by the Austrian supervision. Yeah, that's great news. And yes, good luck. We will come back to the crowdfunding regulation later, but great news today for the ecosystem. Could you perhaps also briefly describe your investment process? How does it work?
The investment process for the investor on the platform, how that works.
Yes.
I mean, we have it's really a marketplace model. So you come, you see all the different types of investment opportunities we have. As mentioned before, we have different types of investors. So we work a lot with tags and filters. So you have the chance to really always see where's the company coming from, at what stage is the company, what type of product am I investing in? Is it equity or fixed interest? You already see that on a first level, sort of where you have all these different companies next to each other with a short summary of information. And then you can deep dive into the companies. With larger financing rounds, we also have videos. So the investor, the issuer, the company is showing himself, talking about his business model. We always have a summary that is very standardized about the market, about the financials, about the team, everything you need to know. And then often we also have information that go much deeper on every company. So as an investor, you really can pick what's my interest. Then you can deep dive into the companies as deep as you want. And then you invest. And that really happens online. You fill out your profile. You pay online. All the contracts happen online. So it's a fully digital process, including identification methods, which is a challenging thing in Europe because it's not harmonized yet, while a lot of other things are. But we also make sure that in our core countries, from Finland, Germany, Austria to the Netherlands, we have smooth processes that are working and allow you to build your portfolio. And if you invested in the end, you have all your investments in one portfolio consolidated at one spot, with reportings you need, with the clear diversification that you can see, with repayment schedules that you can see your statuses. All your contracts are still there. And then again, you have, if you want, access to your wallet for tokenized assets. However, it's not needed at all. So no one needs to sort of browse through the blockchain to figure out where he has invested. That all happens in the background. That's all taken care by us. But if you want to trade at a certain point, this trading possibility will now open up with the new license and the tokenization. And that's something we will build in.
Okay. Your brand INVESDOR seems to be pretty much a statement from my understanding. You try to really emphasize the investor's position. And that brings me to credit risk management and how you perform this. And could you perhaps please tell us how you do this and why you do this?
First of all, the name, I can confirm that. We often had the discussion, it's a two-sided marketplace, or if you're really honest, it's a more-sided marketplace because you have investors that are looking for money. You have companies looking for money, investors looking to invest money. But then you also have the industry, right, of consultants and banks that work with us that use the platform also to bring deals, to finance deals. So we always discussed, okay, where does the marketplace start, right? It's a circular economy. But we really believe that the investor should be in the focus, because if you have the investor base and if you treat the investor base correctly, and if you make sure that in a diversified portfolio there can be positive returns, then you get the trust of the investor keeps investing, and that means that you can get better and better companies. So the investor always comes first. If we look into the process of analyzing, again, we have to distinguish between equity, debt, and renewable energy projects. On the equity side, starting there, we look at it like every VC does. We have a strong due diligence process where we look into, what's the legal situation of the company, what's the financial situation of the company, etc. Obviously, we also analyze the business model. Like, do we believe in the team to be able to execute this? Do we believe in the market that this company is in? What is maybe a bit less is the backwards-looking financial situation. So if you take these companies and look into balance sheets, current cash flows, or a track record over the last years, and let's say you have an early-stage medtech company, producing. We just financed on our platform a company called Next Kidney, which is having a dialysis system that is portable to bring it home. we are still at an early stage with that company. So looking into financials in the background is something we do, but it doesn't tell you necessarily enough for the future. So these companies are analyzed really on business case, on future-looking financials, on plans, on how they have executed on plans in the past. Then we analyze, we write that together, we bring our opinion, and then we go into an investment committee. So there's always an investment committee of experts internally, and we even add external experts depending on industries and asset classes from time to time, discuss these cases and figure out, is this something that we can offer the crowd? That doesn't mean you need to invest in this, and it's not the advice to invest in it. It's really, it depends on your appetite, right? It depends on your portfolio. So we take also a variety of equity investments there. If we look into debt projects, these are, as I said before, more stable SMEs, later stage companies, because again, the upside, if I get, let's say, between 4 up to maybe 10, 12% interest, the upside is limited as a maximum of 12% interest. So the risk shouldn't be too high. So the higher the risk, the higher the interest, but the upside of, hey, the company makes an exit at a certain point is not there. So it needs to be a company that can repay the loan or the bond, whatever finance instrument we use, out of the cash flow. So it's much more an analysis of the current financial situation, the last 3 annual reports that we look at. We look into cash flows and liquidity analysis and really try to figure out, is the company over-debted? Does it have positive equity? All those points we look at. We make scenario assumptions where we also take, critical paths and say like, okay, what if the company does 20% more or less revenue than it plans, or has 20% more or less cost than it plans? And is there still a foreseeable cash flow to repay the loan? If we come to a positive conclusion, then again, we allow this company to come to the platform. Then, we, in the current market scenario, even often work with a bidding mechanism of how to set the interest rate. So we set a range and we feel companies should pay between maybe, let's say, 6 to 8% interest, but we let the investor really also take the final decision on, would he invest on 6 or does he really want to have 8? So there's a bidding mechanism. Sometimes we have projects with fixed interest, but the interest always represents the risk of the company that we have analyzed. If we go into renewable energy projects, again, it's a bit different analysis because it's normally an SPV, a project that you look at more comparable maybe to real estate or something, where you really look also depending on what stage that renewable energy project is. Is it an up and running solar plant? Is there still construction happening? Is it even early stage, more early stage or something? And that's also pure calculation of, are there power purchase agreements with bigger companies? Are there subsidies by the state? And we can make really plannable cash flow statements and then decide to bring bring the renewable platform or renewable energy project to the platform or not. That's what we look at there.
Okay, let's even look a little bit deeper, in particular because of the sharp rise in energy costs. The pressure on companies' creditworthiness is increasing. How are you coping with this challenge?
It is definitely a challenge. Rising energy costs is one, but obviously even starting before you had COVID to look into. After COVID, before the energy prices went up, you had the problem of, do we get enough supply from China if all the suppliers were there? Then you had to look into, okay, maybe the biggest chunk of the customers came from Russia, where you're not supposed to supply anymore. So there's always something in the market to look at. It's definitely something we consider and we look into. We see if we have companies, we talk to the CEOs, we talk to the CFOs, and try to analyze the business models. We see if the assumptions make sense based on, for example, energy prices, and we see if the cash flow still works. What we can obviously say is that with the changing times, cash flows are more often not enough anymore. And we decide against putting these companies on the platform. Because rising energy costs, also meaning rising interest rates, obviously takes out liquidity by the company. On the other hand, you also see that this brings potential. So, for example, having, if you had your customers in Russia beforehand, or your suppliers in China beforehand, building up a supply chain in Europe is a new business model for a new company. So, but obviously we look into all this. And then again, what's important to us, it's not that we have, one global team, sitting in Berlin, analyzing all projects, all types. We have specific analysts for renewable energy. We have asset investment committees for equity cases in the early stage. And we have credit analysts for SMEs sitting in Berlin, sitting in Helsinki, and also sitting in Amsterdam. So that obviously a Finnish company is under different market conditions than a German or a Dutch company is. So yeah, professional analysts, which we hired out of the financial industries and of banks, are what we work with. And also obviously looking at information that we see in the market, credit bureaus, etc.
Okay, thank you. Very interesting. And another question regarding your risk model relates to the historical data. The business is quite young. Mm-hmm. So it came up mainly after the financial crisis. So historical data is limited. How can investors yet be sure that your ratings are sound?
It is limited, but obviously that's an argument that we had to tackle in 2017 when we were 2 years old. Now our combined group is 10 years at the market. So I think we have a certain track record that we have built out ourselves based on the specific type of companies that we fund. We have seen different types of market scenarios because that was also always a question in the beginning by institutional clients. Hey, you only seen the uptrend, now with the COVID crisis, energy crisis, etc. Our numbers also reflect downturns of the markets, upside circles of the markets. So I think there's quite a lot. Obviously, the big chunk of data we buy in. So using credit bureaus, we have at a certain point used and bought data from Standard & Poor's and Moody's. I think it's the same models in the end that data is available today. You don't need to necessarily bring that data in only by yourself. We combine it. We bought data. We looked into, we use public sources for it, for ratings to add in. And we have built up our own database over time now since, over 10 years in different environments.
Mm-hmm. To get a better impression of it, can you perhaps give any numbers for both the requested volume and the actually paid out volume for loans and bonds?
For loans and bonds, around about 60% of our portfolio, we financed 460 million, around about 60% of that is in bonds and loans. If we look into requested to paid out, the quota is, I think, 97% that we declined. Mm-hmm. However, that needs to be clarified because, again, as a young platform, you come to the market, you have an easy, accessible online, channel of asking for a loan, and you're seen as the white knight that now can serve everyone, right? So you get a lot of crap in online applications, basically. So take that aside, still, we decline a lot of cases. We have high hurdles for companies to jump over. So we have requested volume in the billions, definitely. And we try to figure out, of honest applications, in the end, the top maybe 5 to 10% of companies to bring to the platform. In debt, even less. In equity, we maybe have a bit more chances there. Yeah, that's round about the quota that we have from requested to really getting to the platform, bringing to the platform.
It's a very important message, especially for supervision and politics, because what we often hear, is that we take on board everything that banks do not like to finance. And that's really a rumor. That's not true. And it's really great to hear that things are running really very professionally here. Yes.
Absolutely. I mean, that's also for us, when we back then founded the association together, that was exactly the idea that you have obviously seen companies out there and platforms out there that might have tried to go that way and say like, okay, there's a lot of demand. Can we not fulfill this? But then again, we're here since 10 years. We might have, as I said, it's more like a marathon than a sprint. We might have liked to grow even faster over time, but we always felt like the main asset that we have is the trust of our investors, which comes through, keeping a positive return, keeping default rates low, etc. And that's what we had in mind. And that's why we rather decline a bit more and not go that way that, maybe the stereotypes things, and focus a bit more on the companies that are also have been early adapters in the past and say, hey, why only do bank? Why not do a capital market product, which is crowdfunding in the end?
As you have mentioned, senior loans, junior loans, bonds, what can you tell us more specifically about the respective default rates and distressed loans and bonds?
Yeah. Like I mentioned in the beginning, the main focus we have is building a portfolio. And if we have new investors coming in, we have like an onboarding email channel of, I think, 6 to 8 emails or something. So we constantly try to educate and tell, please diversify, because we are not a fund. But you have to use us like a fund. You need to diversify yourself. If you come to our platform and say, like, I picked 2 out of 833 projects, there might be defaults there. So when looking into those, especially if you go, for example, early stage equity, where the return potential is high, but it only comes if you diversify enough. Mm-hmm. And that's our belief also, where we said, like, okay, we need to bring even more diversification by asset classes, by markets, by regions, by stages, by product types, investment opportunities, etc. If we look into, like you said, senior loans, subordinated loans, and bonds, so the whole debt product side, we are steering by getting a positive return. So the important numbers for me are always, what's the average interest rate that we have right now? And that's 6.31%. So 6.31% is sort of the gross interest you get on our platform before defaults. Mm-hmm. And then we look into, that means if you have invested in all debt products we, back in days, have offered. And then we look into what's the annualized, because you get that interest rate every year. So what's the annualized default rate? And the annualized default rate we currently have is 1.48%.
Oh, okay.
So 6.31 minus those 1.48 is a positive net return per year of 4.83. And that's what we steer at. We might need to adjust that even higher, to be honest, looking into the market right now. And you say, like, okay, interest rates are rising. We always had the rule for us, like 4.5% net return on a diversified portfolios we want to offer. Again, we will go with the market scenario. So right now we increase interest rates because the market goes up. Interest rates are obviously higher because market is a bit unstable and you might have higher defaults in the future. So positive net return on the diversified portfolios was important to us. 4.83% is what we currently offer. But again, diversify, please. If you pick 2 projects, it's really tough for us because it would be the same in a fund. If you invest in a fund, you do it for the diversification. Use us the same way. The main advantage is you can pick how your fund looks like, what the projects are you want to support, what are models you want to support, what are company types you want to support, or regions, or do you only want to go for sustainability, etc. That's a possibility you have.
Okay. Yeah, 2 very important numbers you've mentioned, and I think that these 2 numbers are perhaps the 2 most important for investors. Yes, and another very important question from the investor's perspective is, how exactly do you manage defaults? And that brings me to what exactly happens with the claims. What can you tell us about this?
Yeah. Also there we have to distinguish, obviously, a bit into the investment products we have. So looking, for example, in the Benelux market, if we had senior loans there, we often had them collateralized, and even have them collateralized personal guarantees, or it could even be assets behind that. There we hold the collaterals in a so-called stichting, which is like an SPV unit that holds the collateral. If we look into the DACH region, for example, in the senior loan area, we have had unsecuritized or uncollateralized, but also collateralized with personal guarantees in the past. In the senior bit, we do the claims management fully. We try to recover, or we, together with external lawyers, so we have worked with Taylor Wessing there in the past. So we take the claims of the investors and we try, if something goes wrong, to renegotiate the deal. We try to go against the person who has given the guarantee. We try to see what we can get out of the liquidity of the company in case it files insolvency, etc. There you're in the senior position. You can do much more, obviously, and you can sometimes get recoveries of 100%. We had loans where, including interest that was not paid, so penalty interest in the past, you got more than you expected in the first place. Obviously not the normal case, but there's a certain recovery to be expected. Those loans are normally also a bit lower interest because the recovery rates are there, and because you have a position when trying to get a claim, trying to go for recovery. We have also financed subordinated loans or subordinated bonds. These have a bit worse position in that case, because in case of an insolvency, you're standing one step behind the people that get their money first in the senior position. And that means that recovery rates are not as high. You can maybe expect sometimes 10, 20, 30% to get out. Sometimes in case of insolvency, but you should also expect a total loss potential. On the other hand, those loans are therefore higher in interest. So again, the best case is to build a portfolio out of senior, subordinated, maybe with equity, which is even on the higher risk, and then add renewable energy projects, where over the past we had 0 default rates in these areas. So we never had any problems on any of the renewable energy projects. Therefore, these interest rates are sometimes between, let's say, 3 to 8%, So interest rate represents risk, definitely there. We take over as much as we can on the claims and recovery management. On senior, there's something you can expect. Subordinated, a bit more difficult. There's still a need for this product, right? So if we think often subordination is a part also, or subordinated loan is a part of a refinancing structure. So if I take a restaurant chain like Beets and Roots or L'Osteria that we have financed, where there's often a senior bank, financing, there's equity put in by the company, and then there's piece in the middle that is either also filled by equity, but the company is also willing to overpay on interest to open more stores at the same time or more restaurants at the same time. And that's then coming with interest of 8 to 10% of cash flow positive companies, where you say like, okay, the risk comes really with the position, and recovery is a bit harder to get. Again, we do as much as we can. On the bond side, in the future is something to look into, because if you have a tradable bond on the market, then obviously it's tokenized. It might also be traded away from a person that is not even client on the investor platform anymore and traded on the market. There, the German law has really nice, and that's where we like this as well, has really nice bond law where, the crowd, the bondholders, which is the crowd in the end as well, sort of comes together, decides together, and there are clear mechanisms what happens next. So it's highly regulated in that sense. So that's how we currently act for the investors.
Could you also say anything about the numbers? How long investors would have to wait until they get their monies back?
Yeah, also there is no really a standard, to be honest. Like take a senior collateralized loan, then normally you get the money back quite fast, because you take the asset, you sell the asset, and you repay the investor. That might take 6 months after something has happened. Often also, like if we talk about something happens in the repayment, it doesn't need to be insolvency. It's very often also restructuring. The company can maybe not pay right now, but instead of repaying over 2 years, it repays over 3 years. So we just readjust the repayment schedule. So that is often the case. If you really run into an insolvency, then you might have a personal guarantee, and the company is not capable to pay. The person that guarantees starts paying. If you're in the subordinated bit, then sometimes even, to be honest, insolvencies take time. So it could be processes of 1, 2, 3 years until you might then in the end recover 10 to 20%. So again, you should invest the money that, does not need to be highly liquid. We are not a savings account where you can take the money out the next day. We therefore also offer high interest. And again, it comes down to please diversify and mix and match so that you can always make sure that there's always a repayment schedule happening.
Okay. And we heard in Cologne repeatedly the question from investors, what happens in case of insolvency of the platform? How do you guys manage this? So I forward this question to you. What happens in case of insolvency of investor?
Yeah. I think the insolvency of investor is not such a big issue. I mean, it would be a big issue for me, obviously. I wouldn't like that. But the repayment, we don't have a payment license. We are a broker, right? So we broker the loans, we broker the deals. The repayment happens by the company through certified payment providers that then repay the money to the investors. So in case we are not there, it doesn't mean that the money is gone. The companies will just keep on repaying their loans through the payment provider. The question will the payment provider stop paying because maybe the fees are not paid anymore? They paid front up. So the payment provider is paid by us already for the whole term time to repay the loan. So an insolvency of us would not matter for your cash flow coming back.
Okay. Thank you very much for that part of the deep dive. Very interesting to hear so much about defaults, your risk management, and so on. We are approaching to the end, and one question is really important to ask in these weeks. And these are the high price pressures in the Eurozone. Most experts expect the European Central Bank to raise interest rates further. Bank of America, I read in the Handelsblatt, even expect a hike to as high as 3.5% by June. which actually really astonished me. In addition, high inflation is already leaving a growing proportion of people unable to save money anymore. So how do rising interest rates and high inflation affect investors' business model in general, especially in view of the high number of private investors?
Yeah, obviously we need to adjust, but we are part of the market, right? So if a company has financed with us before on 6% interest rate, they also adjust to high interest rates. So we offer that project most likely then for 7, 8, 9% in the future, still covering the same risk, but integrating that basically the no interest rate or the risk-free rate in the market has risen from maybe 0 or even negative interest up to 3.5. So it definitely is impacted by, in general, rising interest rates. This might, for some investors, obviously mean for some retail investors that they turn back from the platform because they feel like, okay, 3.5%, stable, low risk return is enough for me. Then I don't need to diversify the companies. I can put it back to the bank if I get the interest rate of 3.5 is not what you see right now, but you see maybe 2 or something, or 1.5, and then you have these interest hopping investors again. This will definitely be there. On the other hand, there are also quite a lot of investors if you look into the equity market. I think we, for a long time, haven't seen so low valuations in the market. So last year, the years before, obviously companies were higher valued. So the question of when can I make the most return on the equity side? This is the year now. This is the year of challenges. VCs have turned back a bit. Valuations are lower. Companies are still executing properly. They have costs even more under control. And now is the time to invest on low valuations to then profit again from better market conditions in the future, right? So there are different types of investment opportunities on the equity side, especially driven by the lower valuations. And on the other hand, also for us, the renewable energy bit is something to add on. Because obviously you might get 3% if you put it on a bank account. But again, on the renewable energy field, we never had any default. It's a quite plannable process. Rising energy prices brings the definite need for renewable energy, if it's not climate change already by itself. But being a business-driven economy, at least the rising energy prices will bring everyone to, hey, let's think more about renewable energy. And there's a high financing gap. And this is a financing gap that we will also offer and have people invest in that. So I think we will have the retail investors that also consider, instead of having a stable interest on classical, really low risk market products, to get the same on our platform if they go into renewable energy. So I think we have the right strategies in place. We have the broad portfolio that we have, asset class wise, product type wise, but also region wise, sort of always leads to the fact that maybe at the moment one asset class has a bit of refinancing issues, while other asset classes are at the same time rising. So I think in general the business model is not affected, and we adjust to the market. And we will always have interesting projects, and we will make sure that they are market standard, at least, of returns that we offer.
Okay. 2 more crystal ball questions. And the first one is on Basel III, and the second one we have already spoken about it, on the European Crowdfunding Service Provider regulation, the ECSPR. From your point of view, how will these 2 regulatory initiatives impact your business model? Basel III, it will probably make it even more difficult for banks to finance companies. So isn't it an attractive and appealing opportunity for an investor?
It's definitely, it opens up the market. It makes the finance gap even bigger, more need for equity equity requirement on the banking side, less risk that they can take. Take the renewable energy bit, where you can see that over the last years, maybe 80, 90, up to 100% of those projects were financed by banks, and now they turn back to maybe 60%. Still, we need to have the same growth rate in the renewable energy, maybe even more. So the financing gap, this could all be closed by equity, but then the project developers cannot be fast enough opening up the plans. So I think there is a financing gap opening. The whole SME market is obviously impacted by Basel III. The banks are turning more and more and more forced to the standard clients and leaving especially a lot of smaller clients. It's also like often if you say like the unbanked, the companies that banks don't want. We also, due to our digital processes, we are in a field where we can do a 200,000 euro loan with profit. So, and that's often what banks don't do. So it's even a field where there's a white spot between fast, small credits from the bank, which are based on mass, statistics. Then there's a white spot. And then again, there are maybe the 2 million upwards banking loans. But the in-between, where the main bit of the business is, that gets even harder with Basel III. So there's definitely a financing gap that can be closed without higher risks or something on the investor side. Obviously, adjusting interest rates accordingly is always what we do. The ECSPR is exactly that license we talked about. We're the first ones in Germany, Austria getting this license, also in the Nordics, as far as we know. And this will harmonize how you treat investors. So before that, if I had a German SME, for example, and I wanted for this German SME being a capital market product to say like, hey, I also have Austrian clients and I have Finnish clients, and they like you and they would like to invest in your company, the way to invest, the risk warnings, the calculations, the amounts they could invest, everything was different. So for us as a platform, it was quite difficult to offer these products in different markets because we had to do different processes everywhere. ECSPR is regulating that, harmonizing that, saying basically, okay, you're located in one country, but you can offer it the same way in 27 countries. Stick a bit to language requirements, devil's in the detail, obviously, but in general, it's getting more harmonized. It's making it easier to attract European clients because the European Union sees that capital market union is something important. If you look in the US, companies are 70% capital market financed, only 30% bank financed. In China, it's 50-50. In Europe, I don't know, it's 30-70 the other direction. So the capital market needs to come to be less dependent on a bank because as an SME, if you're a small SME, that's your main source of financing. If I would tell you that, a L'Osteria buys pasta only with one pasta production, you would say like, but what if this pasta production is not there anymore? They need to buy from 10 different ones, right? And with refinancing, you cannot do that currently if you look for amounts up to 5 million euros. The ECSPR will bring crowdfunding, digital lending, even to a more professional setup. Take out all these national, sometimes also very low regulated entities. We come out of a MiFID regulation, so we come even out of at least as strong regulation already before. So we have these in place, and being one of the first players, I think, allows us to execute there and to help building this capital market union. So definitely a strong push on allowing us to increase refinancing and show companies to the whole European Union instead of just national countries.
Yes, absolutely. So I have understood that Basel III in combination with the ECSPR might have a very strong impact. And yes, I also have understood that from your point of view, some players might be taken out of the market, because this is what I have heard and already read as well, that especially in view of the high level risk management, compliance management and other provisions, many stakeholders in the European market now think about giving up their business model or at least adapting it.
Yeah, I mean, it's obviously sad for every entrepreneur that has founded such a platform in the past and that is executing their business. On the other hand, it's a professionalization that is needed. There is consolidation needed. All of us, when I talk about 460 million in refinancing volume, but that's compared to the capital market, still a relatively small number, right? And if you want to do it professional, I could not work without a strong IT team, with a legal team, with, as I said, credit analysts in all markets and regions, with a strong operations and finance team, etc. So if you want to do this business professional, there's a certain setup and cost base that you have. And that's why I feel consolidation is needed. Compliance is important. Regulatory framework is important. The harmonization was an important driver, ECSPR. And having smaller companies going out of the market that, were not or are not able to comply with these useful standards is an important factor for us as well in the end, because it allows us to not only consolidate the market, but to professionalize for everyone that does crowdfunding. That, there are no black sheeps out there anymore where you might have an experience that you stereotype over the whole market. So important move forward, but obviously hard for everyone that cannot make it.
Thank you. My very last question brings me to a broader discussion we currently have in Germany, and I address this to you as a founder. You know that we have this huge discussion in space about funding problems of fintechs. And what do you think about this discussion? What is your point of view? And where do you see the ecosystem against this backdrop from here in 1 year?
Well, seeing it in 1 year is obviously like a short-term view on it. I think it's not
5 years.
Yeah,
but I think many seem to have funding problems actually. So I don't know if it is.
Yeah, it's definitely not only the fintech industry. It's in general the whole industry. Obviously, the venture capital is lower, and I think to really take it on a high level, obviously Europe lags behind on proper venture capital funding compared to the US or other markets. Another reason why we also offer equity, right? For companies where we feel they have a useful need to be there. I think fintechs obviously were for a long time hyped, to a certain degree overhyped. A lot of business models where you really need to figure out, and the industry was growing a lot. And you need to figure out who has a business case and who has a business model and what adds value to the market and is not just a nice idea. And that was always something that we looked at also a bit critical. I think a lot of companies also overgrew to a certain extent. They're now coming into the scenario of, hey, let's cost cut and let's think about how we can actually add value and not just spend money on customer acquisition, grow a customer base, and then think about, okay, what are we actually doing with this customer base? And is it adding value to offer a service just purely for free? What's the long-term goal there? So I think, I have a bit critical view on the fintech industry in that sense of being have been growing too fast and have been growing with business models that don't make sense. So it's, I think, also a needed consolidation. However, if we look into, and that's the difficult part I put myself into it, for all business models where you say like, hey, we add value. How do we get this out in the market, right? And currently we also impacted by refinancing. And then again, we also impacted by maybe young fintechs that have grown just based on customer acquisition without having a business model. And how can we now explain that we are different? So maybe the trend goes a bit too fast into the other direction. But I would say that's what I meant. Like if you look into 1 year, we will still suffer by this trend that a lot of VC says like, oh, hey, fintech is overheated. Let's step out for a year, see who's left. But then again, the ones that are left, that have a stable business model, that have a value that they add to the customers, will see the investments in again. And I think that's then the second phase of fintech that is actually useful, right? Right now, we just split up the banking industry and did different things differently. So also there, maybe from a market perspective, a needed trend. Being in the industry, I would like to see it differently, especially, as I said, as it's hard to pitch that your business model actually makes sense. But let's all hope together and obviously work on acting professional, proving our business model, having the economics in place. Then I'm definitely convinced that we also see VC capital going back into the market.
Yes, you are absolutely right. What you have mentioned at the very beginning, that ECSPR event is a very good start for getting serious on that field.
Yeah, it comes with all those, potential downsides of smaller companies going out. But that's the needed trend that is there. And that's the professionalism that is needed. And we have started crowdfunding 8 to 10 years ago. And now we reached a point where it's harmonized on a European level, right? And the Capital Market Union is one of the corner political projects in the financial industry in Europe. And they've taken crowdfunding as the first step and say like, hey, let's make a license that you apply for in one country. And then without properly even passporting it or having a subsidiary in another country, you can use it all over Europe. Let's prove that this works and let's make that step and learn out of it and see where the capital market is. So, for everyone that tells me like crowdfunding, it's there for so long, it's only for startups. No, that's not the trend. The trend is the exact opposite. The trend is that Europe has taken crowdfunding or digital lending, or however you want to call it, and puts it on the main point of the agenda and says, let's start from here. So maybe that marathon was just you warming up for the sprint that happens actually now. And I see high potential there.
Thank you very much, Christopher, for your time. That was a great episode number 3.
Perfect. Thank you so much.
Thank you everyone for listening. I hope you have enjoyed this episode as well. Please make sure you subscribe to our podcast and follow us on LinkedIn so that you will never miss our podcast. Stay safe and sound, and see you soon.